Liquidity in forex trading is quite a big topic, and what people don't understand is there's a difference between smart money concepts and the way they teach liquidity and liquidity in price action. Now, this is a topic that I haven't seen many people cover, or if anyone covered that I know of, and it is something that I want to express and talk about, that there's a big difference in the liquidity scene in price action trading and the liquidity that smart money concept traders trade out there. And in this video I'm going to cover the differences and hope that this can affect and help your trading. So that being said, let's get straight into it. So welcome back guys, Harry here, known as Tradesharpe, and this is going to be a great video where I'm going to explain the differences between price action liquidity and liquidity in smart money concepts trading, because this topic is really taken too far on the internet these days and it's something that people have to understand. So the first thing is, what is basically liquidity? Before we get into that, if you're new to the channel, welcome to the channel. Let's get all of that YouTube stuff out of the way. If you could like, subscribe and do all of that, it really does help, and there's plenty of content. This is going to be a continuation video to my last video, which is I compare smart money concept versus price action. So check that out. It's a non-biased opinion and I hope that will give you some clarity, and tell me if you agree. Leave comments down below on this video. It really does. I do enjoy reading them. And down below are some free groups that I highly recommend you join, because there's my analysis and stuff like that. Instagram is there as well. Everything is all laid out. And now let's get back into the video. So liquidity basically is a very simple concept. Well, not simple, it's a complicated concept in two ways. It's a simple concept in price action, but it's a complicated concept in smart money concepts. So smart money concepts is where people believe that they trade as close to institutions and banks, and the problem with that statement is there's no real way of knowing how institutions and banks trade, because they trade based off very advanced algorithms that are constantly changing and adapting, and there's many methods. So as a retail trader, all we can trade off is patterns that we see repeat on the chart, and that is fact, right? There's no way to see order flow in the forex markets. All of this is fake. What is liquidity? Liquidity is basically, see, there's two ways that people define them. The smart money traders defined it as orders, stop losses, manipulating, taking liquidity from one direction to move chart the other direction. But as far as I know, and as a price action trader, liquidity simply means it's just orders in the chart, right? You need orders to move the chart. You need people buying, you need people selling, and you need both at the same time, believe it or not, because markets work on a one-to-one basis. For every buy there's a sell, and for every sell there's a buy. So without this equilibrium, there is not going to be market movement, right? So at times there'll be more buyers and at times there'll be more sellers, but the market always has to come back to one. Otherwise it's not going to operate. And that's why we have liquidity in the markets, because it means if there was no seller when you're taking a buy, you could never close your buy because there's no opposite party to fill that order. And that is simply what liquidity is. It's not hunting your stop losses. It's not trying to find where your stop is so it can hunt it to take. The banks are not looking for your stop loss. They don't care about your 100, 200, 300,000 dollar account, $500 account, or $1,000 account. They don't care. They need big liquidity. We're talking billions of dollars here in the forex market. So understand that all that is, it's orders, and it is important because you need price to have volume, and in order to have volume you need liquidity in the markets, and you can see that from many different ways in the chart, from how the chart's moving, which I'm going to cover. One of the concepts that smart money traders made is they made the concept of liquidity, and essentially they trade liquidity in terms of zones. If there's high here, they believe that there's liquidity sitting above this high basically, and they look for the liquidity to be taken to continue price in a certain move. And although that sounds like a good idea and it does happen, and obviously because that's why they make a plan out of it, it's not always the best way to look at liquidity. So smart money traders, and I'm not going to speak 1000% about smart money trading because I am a price action trader, but as far as I know, they look at two ways in liquidity. Either we have highs like this, which this would have been taken a liquidity out of these highs, or you have some lows here, and once price it validates these lows, it takes liquidity below these lows, because they believe that there's orders, there's people's stop losses that get taken, which gives the market opposite liquidity to move. Now, that is putting too much of a story and too many variables into your trading. The more variables you add to your trading, the more likely you are going to lose, because you're adding more probabilities and more statistics to be wrong. not necessarily to be right, and that's what people have to understand. The more simple you can keep trading, the easier it is, the more probability you have to win, because there's less variables causing you to lose a trade. So there's nothing wrong if this works for you and it's something you trade very, very good, but what you can't deny is structure. So if we take that example of how these lows here could have been seen as liquidity and this taken out the liquidity, as you can see, there's no big reversal here, because Y trend has been bearish and we've been in a range, and we just continued the trend for the rest of the day. So essentially, of course, there's going to be different spots of the chart where it would make sense to take liquidity, and I understand. I can see the people already in the comments going to say, no, that's a wrong area for liquidity. But for example, if we take this zone right here, so a lot of smart money concept traders at this point here would be looking at these lows here, expecting it to be taken out, and what they don't understand is maybe in the session there was a trade to these lows, right? Which is going to be more important. And I know that before smart money concept traders comment and tell me, yes, we do target liquidity areas and this would be a target. If we go forward here, just on an example, very recently, you can see, okay, it took these lows, now they're in buys. Okay, let's see what happens when they take buys, right? Because they targeted the lows, they took buys from the liquidity sweep, and now what? Let's see what ends up happening. Oh, it dumps back down, right? So really it starts to become confusing. But if you looked at price action and we made it simple as a price action, we see that these are lows here. Price closed below, made a lower low, never broke the low. We see it pull back, then close back outside the range, creating a lower high, essentially like this. And you can take a trade to target these lows and potentially continue. So your target would be these lows here and continue. So you can see how there's two ways to analyze the market here without even needing liquidity. But as a price action trader, the liquidity would be this move here, because this is price going up, making a lower high, grabbing enough momentum to continue price towards the downside. And if we skip, we range around and eventually start breaking down even more further until we reach this level of support in here, and we start rejecting and making our way in a range before the end of the week. So now I'm going to talk about liquidity in price action trading. Liquidity in price action trading means what momentum do you have in a move. It's not complicated. We're not targeting liquidity zones. We're not looking for stop losses to be hit. No, in price action trading, liquidity simply means what momentum do you have in a move. So if you're buying, let's say you have bullish candles closing like this, bullish candles closing like this, bullish candles closing like this, you don't know if the next candle will close bullish, because you don't know if there's enough momentum, volume, or liquidity in the market to continue. You either need to wait for price to give you a pullback, which is going to give you enough liquidity, or it's going to give the liquidity to give the further upside move once you get the confirmation of support. All we're looking for is price to pull back to give us more of an upside move. Think of it like it pulls back, it takes one step back to take two steps forward. It takes one step back to take two steps forwards. And that's what we want to see in the market. That's why the markets don't always have a straight push. We see these pullbacks. These are simply taking one step back to take two steps forwards. And this is basically grabbing liquidity and telling us the market has momentum. The market is continuing in a trend, and that's how trends are defined, right? So essentially, how is this going to help your trading as a price action trader? Well, first of all, when you're seeing big moves happen in the chart, candles like this, for example, just one after the other, one after the other, one after the other, you want to look for some sort of pullbacks. And this is a great example here. All of these candles here, this was a news event candle here, but all of these candles here on a straight upside move here on the 15-minute, if I went to the 1 hour, it would just look like straight green candles moving towards the upside, right? So as you can see here on the 1 hour, it's straight green candles moving towards the upside, straight green candles moving towards the upside. But on a 15-minute, if we scroll back to that, if my charts will load, come on DJ, there we go. You can see how these moves are actually have these slight pauses, and these pauses give us an entry option because they're grabbing liquidity, grab liquidity. And this is all I said, as I said earlier on, this is just giving us a pullback to continue the move, and this gives us confidence as a price action trader to enter the move. So how is this going to help your trading in price action? Basically what this is going to do is that this is going to teach you not to be entering on just pure green candles. You need to see structure, you need to see price break that structure in order to tell yourself, okay, we have gone down, we've collected liquidity, we can see more upside movement. Here's a great example. We all know one of my nice trades is if we can get a closure outside of a range and we have a target. So let me find a clear example here. Well, just recent example, something like this. For example, if this is your range, you can see this candle closed above the target is going to be the top of the range here, right? So this trade did take some time here because of the time. This is actually around just towards the end of New York going into Asian session, which is around this time here. So around Asian session we started ranging, but you can see how the trade eventually played out. But what happened in the trade is important. So your stop loss would have been somewhere here, target here. This is just a random trade 1-to-1 at this point. But essentially what happened is we got the closure outside the range after creating structure. We can see how price rejected this zone, rejected this zone, rejected this zone. We're creating upside structure, but we also have a resistance. So we can't just take buys randomly because there's no confirmation. We don't want to be stuck in one of these pullbacks. But the confirmation we have is once price closes outside of this zone, it's closed out of the resistance that price struggled before. So this should give us the upside move to the next resistance. Why? Because we have an LTA here, and this is the zone that we should be able to fill, right? But the confidence comes from seeing this structure form in this area, showing us that price is rejecting. All that's doing is collecting orders for upside, collecting orders for upside. And you don't have to make it complicated. You don't even have to look at that, right? But this is what I'm just trying to compare and show you the difference between price action and smart money. And eventually you can see, boom, when we get the close, we get a nice volume push. Then it ranges, needs more to grab more orders, but still respecting this zone. This is the key part. Still respected the zone, and boom, eventually hits take profit. And that's basically it. And that's all I want to explain. It's a little bit, might be like a complicated or even a useless video, but all I want to show you guys is that there's two ways to look at liquidity, and it's not a topic. The main point of this video, it's not a topic that is meant to confuse you. It's just something in the charts that you need to understand that they need, and it can give you more confidence in your trading if you understand it in a simple way. That's the only point I wanted to get across in this video, and I hope it does help, and I hope that smart money traders do agree with me, as well as price action traders can benefit this. So with that being said, take care, trade sharp, and until next time, peace.